Hello, everyone. It's Charles Brown, CB3 Financial Group, and this is Friday, March 6th. Talking to you today about what's been happening in the market this week. Lots to get into. Stick with us. CB3 Financial's weekly podcast begins now. Thanks for staying with us, folks. Here we are in war times again. Those of you that have been with us a really long time, remember 1991 in Kuwait. We were managing money back then on the future side, so only a couple of you have been with us that long. But you remember these times. We get through this. It's ugly. The market is very volatile. Back then, of course, 34 some years ago, we didn't really have much of an indicator. The VIX was barely in development. And it's hard to measure volatility that many years ago, but now we can measure it. In some ways, that's good. In some ways, it just creates additional angst. What drives the market in the long run, as you well know from years of listening to me in my live speeches and on CB3 Live for the last 7 years, is earnings and interest rates. And that's what's going to win out here once this uncertainty gets beyond us. And that's why I'm not talking from a script. I just want to talk to you, my clients, and just reassure you, I am here almost 24 hours a day at my trading desk, making decisions on your behalf. Normally we trade on the first day of the month, the first trading day of the month, which would have been Monday, March 2nd, but we didn't trade CG until yesterday, and even tweaking some positions today. And that's simply because the markets were so volatile. You don't want to trade in those kinds of environments because the bid offer on various stocks is just too wide and you get hurt on entries and you pay more than you should. So we elected to defer on that. I've got a lot to tell you about on the Thursday, March 12th show. So that's 6 days from now. That show will be a continuation of the theme that we started last month, which is always adapting. And that's because that's what we have to do now in this environment. We've done it for 30 some years. When geopolitical events step into the culture of the market and basically force us to play even more aggressive defense. Realize that as portfolio managers, and not just me, but all of us, we're always playing defense. We're always the cornerback or the safety. We're not the wide receiver. They know the play they're running. The market makes up its own mind, and all the collective people trading drive the market in a certain direction, and we have to react to it. Our ability to predict is not nearly as important as our ability to react. And that's what we've been doing. We are aware that CG, our flagship program, has had 2 pretty bad months, 2 struggling months. This is not the first time that's happened. You can look at our performance. It's published on our website going all the way back to 2011. And we recover from this because we adapt, just like a cornerback that doesn't want to get in a position where he's given up touchdowns, 4 or 5 times a game. You learn to adapt. And that's what we're doing now. We're going to sectors that have been out of favor. We're adding some industrials. We're pulling a little bit away from tech during this time frame, although still keeping to the mandate in DS, for instance, where we're still in Magnificent Seven and reweighting some of the Magnificent Seven that haven't been performing as well. So the U.S.-Israeli strikes obviously is what's at the top of everyone's mind. Crude oil left the 60s into the 70s and finished today about 81 and change. We've apparently killed 1,500 plus leaders in this attack. This is not just the U.S., of course, it's Israel. And it looks like now that the war is going to be expanding into some of the European countries helping or assisting in this battle, basically to try to remove one of the most ruthless dictatorships in the history of the world. This has been an issue the U.S. has talked about since 1979, back when Jimmy Carter was president. So the only reason I'm talking about this is because it does temporarily take our minds and focus off of earnings and off of interest rates. And the Federal Reserve, of course, the big uncertainty there is we got a new Fed chairman coming in 2 months. And we're not even, he hasn't even been approved yet. It's going to be interesting to see if he follows the Trump manifesto there and lowers rates. Right now, I think the sentiment is across the economic leadership in this country that this is not the time to lower rates. In fact, a firm dollar would be a welcome advance. Now, we've hedged in our portfolios by buying European securities, which generally do better when the dollar is weaker. So we're protecting you there. Again, that's been a defensive move. It certainly looked like the dollar was going to be stronger when Trump came into office. But with the additional spending, because Trump has not stopped spending, everybody can blame the Biden administration all they want for being spendthrifts, but that hasn't been a factor with Donald Trump. He's spending money just like Joe Biden did. He may be spending it in different ways. But what this means for us as portfolio managers is that when we have a day when the Dow's down 784 like yesterday, it rattles some cages. But do realize this is why we instituted the options hedging in CG, DS, and GI. All three programs have options hedging. I've been talking about this now since September. If you have accounts with us and you don't understand this, I can explain it to you in 90 seconds. I can't do it in 30, and I don't need 5 minutes. I can't do it in 30 seconds. I don't need 5 minutes. But I would like you to understand what we're doing on your behalf to cushion the blow during these downturns. It's really important to me that you understand that. In weeks where we've got, West Texas Intermediate, which is domestic crude oil, moving up and down, 8 to 12% in a week, it affects equities. And those equities obviously are in your accounts. And if we can hedge that, basically the option spreading is designed to reduce downside because the options hedging gains in value when the market goes down. So think of it as you're driving along with one foot on the gas pedal and one foot on the brakes. I don't recommend that out on the Eisenhower for those of you here in Chicago or on the Dan Ryan. But when you're investing, especially in a volatile environment like this, it can be really helpful to have that tool available to you. So one of the other big stories that's happened since the last time I've spoken to you is that the Supreme Court, with a 6-3 margin, struck down the IEEPA tariffs. I mentioned that on the last show, and we're still seeing now how that's going to manifest itself because Trump has pivoted saying, well, I'm going to use Section 122. Interesting enough, Justice Gorsuch said as he voted against IEEPA, said, well, here, President Trump, this is what you need to do. So it's a mixed message from SCOTUS right now, Supreme Court justices. But we're just in a crazy time right now. We've been in these times before. 2024 was not one of them. And that's why we had such a terrific year in 2024, because markets left to their own, if earnings are going well, and if the Federal Reserve is at least being neutral, if not dovish, markets tend to do well. The VIX stays well under 20 and markets move higher. So that's what we're seeing here. Guys, I know that this is an anxious time. It's okay. Send me an email. Give me a call. I'll call you back. If I don't pick it up, I'm probably on the phone with somebody else. My job is not just to manage your money, but to put you at ease, letting you know that for 34 years now, I've been doing this in front of the screens every day, most weekends, because this is what I love to do, and protecting your money, but still growing it in the most cost-effective and risk-adjusted way that I can. That is my top priority. There will be times, and we've had clients that say, you were down 60 basis points when the S&P was up 5 basis points. And on any given day, that is certainly possible. We had a day like today where the market was down 54 basis points and CG was down less than half that. GI was down less than half that, and DS, I think, was actually up a few points. So the programs don't always move in lockstep with an index. If they did, you almost wouldn't really need to have an investment program. You could just buy the S&P 500 and ride it up and down all the time. That becomes a problem, though, if you're at a stage of life where you really can't have a 50% hit like we had in 2008. or a 32% hit like we had during COVID in just 6 weeks, right? From February 19th to March 23rd. It's hard to believe, but we're 6 years now from when that happened. You have to have some kind of downside protection, and that's why we're doing what we're doing. It's important to me, as I said earlier, that you guys understand what I'm doing on your behalf, managing your money. It's really, really important. Give me a call, shoot me an email. I'll get back to you. We're going to be fine. Been doing this for 30 plus years. I've seen these times before. We'll see them again, but we're going to be fine. You guys stick with me Thursday, March 12th for the next CB3 live show. Don't miss it. I will see you then.